Hello and welcome back to the week ahead in our new location. Now, I'm Rowena Harris-Doughty, and joining me as always is LCG Senior Market Analyst Jasper Lawler. Jasper, welcome back. Thank you very much. Now, before we go on to talk about the week ahead, I want to briefly touch on the Fed meeting minutes that we had this week, which caused a bit of a stir in the stock markets and, of course, for the US dollar. Now, the whole idea of the Fed's plans to start shrinking its balance sheet, in simple terms, the stock markets have reacted, as we know, obviously, because the Fed would technically be offloading risky assets back into the market.
Yep.
For the US dollar, on the other hand, they're not happy simply because if they start shrinking their balance sheet, then of course that means we're slowing down the pace of rate hikes. So what's your outlook then for the US dollar and of course the US stock markets, given the recent news that we've just heard?
Well, you're right. There was a big reaction in stock markets. At the time, the market, looking at the Dow, for example, the US 30, Wall Street as we trade it, it was up pretty good on the day. It was looking like breaking out almost back into testing record high territory, and then fell and closed lower on the day. So that's a key reversal. That in itself was quite a big technical worry. And then you look at the reason behind it. Well, this was the big fear that has really gripped the market all along. Rate rises, we've managed to tolerate that. The Fed's lifted rates 3 times now. Market's still drifting into record highs. But the balance sheet was the big unknown. Now they've actually mentioned it. And they've been a bit more overt than many people expected. Wasn't really expected to be a big issue in the minutes. But actually they've listed the end of the year as being the time in which they could actually start to shrink it. And as you said, I mean, it's selling bonds in the portfolio, MBS or treasuries. The buying of those helped all asset classes rise. So the selling of them theoretically could make all of those asset classes fall, and that's what we've seen perhaps the first inkling of.
So could we see some more pressure on the US dollar?
Well, the thing is, the reaction in the dollar was obviously lower, as you said, because at the moment they're saying that they paused the rate hikes in order to do the shrinking of the balance sheet, because that in itself is a form of tightening. Now, were the economy to do well enough that they'd actually start doing both at the same time, so tightening through the balance sheet and tightening through rate hikes, then the reaction of the dollar would be very much different. And then that's when this divergence trade really kicks in. That could be a very strong dollar environment. It's not what we're seeing at the moment.
Okay, so an interesting one to watch then. Well, moving on actually to talk about some of the data releases we've got next week. On Tuesday and Wednesday, we've got UK inflation and UK employment data, respectively. In terms of the pound, what's the biggest factor influencing the pound right now? Is it that we should be focusing on getting some strong economic data that hopefully we're going to be seeing? Or is it still, okay, now Article 50 is triggered, is it still all Brexit, Brexit, Brexit?
Typically the answer is not simple, it's just a combination of the both.
Yeah.
I think Brexit is now obviously Article 50 has been triggered, so now we start getting more details on the actual impact of Brexit. We're only a week in, and already there's been some pretty high-profile squabbles over Gibraltar, for example. Yeah. So the EU obviously playing hardball here. I don't think anyone should have expected anything else. It's going to be a tricky ride, and the pound is going to suffer every time there is a big surprise curveball thrown like Gibraltar in there. You wouldn't expect that to be a big factor. But that just shows how closely tied the UK is to the EU, and it's going to take a fair bit of unravelling, and there's going to be some trouble along the way. That's negative for the pound, but the Bank of England, even recently, have sort of started talking more about rate hikes. And at the moment, there's quantitative easing, and that could even end as quickly as March. So there's the distinctive economic positive influence at the moment, which I think is why the pound is holding above 120. We've always got those Brexit risks down the road.
Bumpy road ahead.
Absolutely.
Also coming out next week, we've got a flurry of Chinese data releases. Now, back on the agenda, there's a lot of chatter and concern again about China's economic growth stability, how stable it actually is, and how much stimulus is actually just propping up demand. So whether we are actually seeing enough actual self-sustaining growth. What's your thoughts on this?
I tend to be in the camp that I think China is papering over the cracks with stimulus. Actually, the growth is not as strong as the headline figures would suggest us to believe. And even the headline, the People's Bank of China and the Chinese government have reduced their growth target to 6.5%, so it's lower than the previous year. But to get that target, they're probably going to have to keep the stimulus going. The question is, when does that all come home to roost? You can't keep piling debt on top of debt. And they've stopped official issuance of, most of this debt kind of comes through the various states and regions. They've stopped the official release, but there's sort of unofficial channels in which this debt is being increased, and it's not really being incorporated in the numbers. So that's what generates a bit of the uncertainty. It's not all right there in black and white what the debt levels are. We don't really know. We have to speculate a bit. And obviously, if there are signs that things are unraveling there, in the back of your mind, you've got, well, there's all this debt and we don't even quite know how much.
Yeah, of course.
China is definitely one of the top 5 potential reasons for a market collapse at some point. We're obviously not there.
Don't scare everyone, but no.
Don't worry, guys. No collapse at this. But well, I say that. But good for trading if there is. Not so good otherwise. But it's a risk. China's a big risk factor, and at the moment it's interesting. Obviously, at the moment because the tail end of last week we had the meeting between Donald Trump and President Xi of China. US-Chinese relations are going to play a big part in how China's economy goes forward because Trump has been pretty hawkish on China. If he actually starts to follow through on those policies and they can't work out a sort of amicable way of sort of meeting his expectations but still being good for China, then obviously relationships sour. They're the 2 biggest economies in the world. If trade between them sours, then that's bad for the rest of us.
Well, on top of that kind of volatility, obviously, typically, as we know, bad news out of China in terms of data, etc., is usually weighs on commodities and, of course, the Aussie dollar. Do you have any particular technical outlook or base case scenario for them?
Well, I think we could throw up a chart now, particularly of the Aussie against the yen. That's good because they're both Asian currencies, so both sort of heavily influenced by China. But yen tends to be the sort of safe haven currency that people go into in times of concern. And the Aussie benefits from, it exports about 35% of its exports go to China. So it's heavily influenced by China's economy. If the news from the US-China relations starts to sour, that's probably bad for the Aussie. If China's economy starts to roll over, they have raised interest rates a couple of times. Yeah. If they start to not lay on the stimulus quite as much, again, that's a risk for the Aussie. And I mentioned this Aussie dollar yen chart. There's big technical support, which it's right fluctuating on at the moment, and a break through that is quite clear-cut horizontal support, which you don't always get. A drop through there could have a lot of people concerned.
Okay, an interesting cross to watch there. Thank you very much, Jasper. I'm afraid that's all we have time for today's Week Ahead, but join us next week. Don't forget to connect with us on social media. Goodbye for now and good luck trading.